Hey, good morning, everyone. Welcome to the Macro Snapshot. This is Wednesday, February the 25th, 2026. We are recording this in the morning. Okay, let's have a quick overview and see what happened overnight. Basically, not a huge amount of sort of information. We did get the state of what's it called? The State of the Union address from Trump. Personally, I didn't see anything sort of massively important. There was some stuff of 401k contributions of $1,000. There was talk about Iran, but nothing really specific. A lot of sort of domestic politicking and political rhetoric. What was maybe the most interesting was sort of, again, a little bit vague, but something to the effect that sort of AI companies would have to pay for their own electricity for sort of data centers. We'll see how that plays out. But as I say, nothing which I think is massively sort of market moving in the short term. I mean, quite a lot of positivity, and of course, Trump tried to sort of sell his vision of America's economy and generally was sort of upbeat. In terms of what's going on in the equities, obviously we have Nvidia today, but what is interesting, you see here a little bit of positivity, a lot of positivity globally. Like, first of all, let's just have a look at that and just see what's happening globally. And again, even though the US is sort of, sort of churning, trading within a range, as like you see the Nasdaq here sort of in a range and sort of trying to sort of poke its head above water. What is actually fairly extraordinary is really just the outperformance of the rest of the world. I mean, we see here just in general the SPY ratio with the sort of other developed markets like Europe and the Far East. And you can see that, I mean, maybe a tiny bit today, but essentially the rest of the world has been, of the developed world and also emerging markets have been outperforming. And that is continuing. Just very quickly, you see a snapshot here. Let's say Euro Stock 600, almost trading at highs, very, very positive chart. Let's say we look at the Nikkei doing super well, up 220 basis points. Basically, there was a bull flag, which actually has broken out. And essentially, less hikes, a weak yen, export market is really sort of being supercharged there. I was just reading exports, I think year over year, up 16%. A government which wants to stimulate less sales taxes, more liquidity for bonds. They've taken a lot of sort of specific measures in the bond market to ease market concerns about long term. So they're kind of issuing more at the belly and buying some off the run bonds, which essentially is bringing the yields down. So quite a lot of technical measures there to sort of stabilize the bond market. Takeishi doing a good job, and the stock market is loving that. So the topic's up, the Nikkei, which we're looking at here, sort of ripping to new highs. If we look over a similar kind of situation in Korea, I mean, this Kospi is just going nutso at this point. And I mean, I would be tempted to say sort of parabolic and, try to short this, but, at your own peril. And the reality is that behind the Kospi, you have a very, very supportive sort of prime minister and government, which is actively supporting the stock market and actively trying to say to people, hey, instead of putting all your money into real estate, why not support the domestic Korean stock market? Like, this is an actual policy. And keep in mind that the Korean prime minister, who's put in a lot of sort of corporate governance reforms and tried to clean up corruption, has been in power for, was it 6 to 12 months or so. He used to be a day trader. So he used to be a day trader of stocks. So he is very much focused on the stock market. So my point being here is that normal people, they're called the ants over in Korea. The day traders are sort of pumping money into the stock market rather than into real estate. So it's not necessarily a given that this is going to collapse and it's a sort of overextended, because there's real reasons. You've got Samsung, SK Hynix, SanDisk, all of these companies are actually at the forefront of the boom in sort of AI infrastructure and chip making and memory cards and all that kind of stuff. So anyway, just interesting. Obviously, to get into this point is a little late in the game. Sort of a middle of the ninth innings, so to speak, with a baseball analogy. But just it's a crazy performance here. China not doing as well. If you look at China, it's a bit more like the US, kind of sort of grinding away. And if you look at the sort of the blue chips, the A50, that's actually quite weak. So China definitely underperforming. But if you look at Brazil doing super well, and then if we look at something like emerging markets, you can see that's also at high. So really the theme is, sort of US and China doing, relatively solidly, but sort of grinding with a lot of rotation. But Japan doing very well, Europe doing very well, Australia doing quite well, and the emerging markets doing very, very well. So a little bit of outperformance by the rest of the world, especially the emerging markets, and let's call it sort of, with the exception of China, Korea, Japan, and Europe. And those themes remain in place. So if we go back to the US, I was just going to grab some tea. It's the great rotation, and we've spoken about that a lot, so I'm not going to speak about that particularly today. But we know that there's this whole thing of, semiconductors. I mean, look at the semiconductors almost making new highs. And yesterday, when the market was fairly positive, we did get a little bit of a bounce on the software, which was but still very, very sort of weak price action. And we're going to have to see a lot more. And just to give you a sense of some of this, I just want to show you just a nice sort of a comparative grill, which I found, which essentially is, so basically here you've got, as it says here, it's the ratio of the 3-month sector relative symbol. So this is all that a lot of the big technologies. So you'll recognize ARC and Quantum and SMH, for the semiconductors, XLK, of course, is the S&P 500 sort of technology sector, hack, cyber. And you've got IGV, which is the which we've been looking at a lot. So it's quite an interesting one, maybe even to screenshot here. And you see basically the relative performance. And you see that, for example, something like SMH, the semiconductors, you just see this is the outperformance over the last 3 months versus a lot of the other sectors. And then if you look at the weak one, let's say the software IGV, you just see how much that's sort of underperformed all across the board, everyone. So you see this very, especially in the technology sector, a huge amount of sort of rotation. But what we saw yesterday was kind of interesting because there was some positivity. And I think where we're at the moment, there's really sort of two big narrative shifts, and the market seems to be trading day in and day out, or one day and one day the other, on these two different sort of narratives. And one narrative is this is something typically it's like, oh, AI is going to destroy and replace jobs, and it's going to destroy software as a service companies. And typically like that Citrini report, which everyone was sort of mentioning for the sell-off a couple of days ago, which essentially said that within 18 to 24 months there's going to be 10% unemployment rate, and white collar jobs are going to be absolutely destroyed. And again, I read the report, and it's a scenario analysis. It's very much a what if, and it's a little bit of a sort of a slightly alarmist sort of thought bubble. But that really got the market's attention. This whole idea that AI is going to destroy white collar jobs it's and really at the bigger level is that AI is coming to replace and destroy big swathes of the technology sector. But whereas yesterday we had a slightly different take, which was positive, and part of that was, let's say, at Anthropic. And I just want to give you a sense of how the sentiment can change. So Anthropic had a big sort of presentation of a lot of their technology, and it was kind of interesting because there was just a comment from Deutsche Bank which caught my eye, and I think this summarizes how that there are still competing narratives here. And this narrative here, this is from Deutsche Bank, saying, after watching Anthropic's enterprise agents briefing event, we have even greater conviction that model providers, so this is the AI companies, model providers are unlikely to displace. So remember, this is not saying destroy and replace or displace. It's saying they are unlikely to displace software incumbents. So these are the companies, your Microsoft, your Salesforce, SaaS, software as a service companies, which already have these subscription models. So they're saying they're unlikely to replace these guys and are instead positioning themselves and their agents to be an orchestration layer on top of existing and incumbent systems. So rather than sort of saying, hey guys, AI is going to destroy everything, they're basically saying it's going to sort of, orchestrate, it's going to be collaborative, it's going to be an overlay, and it's going to drive productivity, and it's going to sort of help these companies. So I don't know. And the market certainly has not thought about this perspective. Definitely the last week or two has been a little bit the other perspective. But what I'm trying to say is there are shifting and competing sort of points of view. And for example, just interesting that the Deutsche Bank is going, hey, and this is also coming from Anthropic themselves. Anthropic yesterday were at pains to say, hey guys, we're not here to destroy everyone's business. We're here to help people to improve, to drive productivity. And that's why we did see a little bit of a positivity yesterday in things like the software sector. We saw that IGV ETF was up, what was it, at 1.5 or 2%. We saw that a lot of companies like Microsoft had a little bit of a bounce. So as I say, it's really a bit sentiment driven here, and no one quite knows how this is going to shake out. But I think we have to keep in mind that a lot of this is sentiment driven. So of course, what we do have today, which is going to be a big factor in terms of sentiment, at least in the chip section, is our dear friend Nvidia. So let's just quickly remind ourselves. Let's have a look at the chart here, which I think I looked at a couple of days ago. But we'll just keep an eye and just from a technical perspective, see what's going on here. And what we can see is that yesterday they had a nice little bounce. Now, if you look just here at the fib retracement, you can see here, first of all, we're getting to recent highs. The very important point here, you see it's kind of like a quadruple top at about 194. So 194 is obviously a key one. And then, of course, we have the fib level at about 196.5. So, but this is, as I say, at this point, one could argue that it's pretty constructive price action. So again, just to go over this, you can see that we had this sell-off, bounced off the 200-day EMA, and from a technical perspective, you could see here that you say, oh, it didn't, break the recent highs, it didn't get to the fib levels, and that's all true. So that was a little negative, but then the bulls came in at the 61.8% retrace in the 65% fib pocket and bounced nicely. So this is constructive price action. This is positive. And if we wanted to measure out, let's say, a Fibonacci extension, the targets at this point, just going from these anchor points, you could say that the targets are, obviously these recent highs at about 194. Then you've got the fib levels at about 190, what's that, about 196.5. And then you've got, even pushing up here. So just from a technical analysis perspective, the Nvidia chart is positive. So let's now just see a little bit what the market is pricing in. So I just dug out, and again, the cash market's obviously closed at the moment. So these are screenshots from just before 4 p.m. Yesterday. And what I want to do here, whoops, sorry, that is actually the wrong one, is just to look at what the option market, what the market is kind of expecting today from Nvidia. So this is the option chain here. As I say, snapped about 3:30 yesterday afternoon, so just before the close. And obviously this will be slightly different this morning, but not massively so. And what you can see here is that we do have, first of all, very high implied volatility. So I just want to put this in perspective here. If you look here at Nvidia down the bottom, you can see that the 52-week implied volatility ranking is 31%, which is not the worst it's been. But if you look at the percentile over the last 52 weeks, where we are on a basis of comparing to the last 52 weeks, we're at 76%. So you are paying up for high implied vols, and I'll show you what that means here. So you see here the at the money implied vols is 85%, and then as I say, if you're looking at the straddle cost here, you're looking at the straddle. So you see here with the deltas of 46 and 53. So basically that was your at the money straddle. I think it's more like it's around about the same, but essentially you're going to be paying up around about almost $12. So you'd be paying almost $12 for this sort of a straddle. So that's expensive. And then if you look at that, you say, well, okay, $12, that's about a 6% move. So the market is pricing in approximately a 6% move. So if we actually look at that, if we look at the pre-market here, so you're looking a 6% move. You're looking at a top side of around about, if you're going to go for the straddle here, you're looking at about $204, $205 on the top side. That's what you're paying for. That's what's priced in terms of your straddle. So on the top side, as I say, about 200, let's call it about $205. On the downside, your 6% gets you down to about 180. So you're looking at a range of about 180 to about 205 in terms of the actual cost of the straddle. So just going back to just to get a sense of how expensive that is, and just what the market is pricing in. Just to look at some of the tools to measure this. So let's look at the volatility lab here, and you can see that if you look at the March the sort of monthly contracts here. So you see that has been going up steadily, and it's now at about 52%. But really what should get your attention, so just keep in mind, this is the sort of the March sort of option expiry here at about 52%, which has been rising. But then if we look at specifically the Feb 27, which is basically the Friday one, so that's the closest one for in Nvidia, you can see that that's way above the March one. And you see this is essentially the earnings premium. So you see you're essentially paying just for the premium here Well, a 30% implied vol premium. So very, very expensive if you want to be long gamma today in terms of a long call or a long put or a long straddle. So just keep in mind that you are paying a hefty, hefty sort of premium for the privilege of having long gamma. And as soon as the earnings come out, of course, normally there is a volatility crush. And you'll see that 80% implied vol is pretty quickly going to come down to 70 and 60%, I would imagine. Now, the other thing as well, just it's interesting just in terms of the options here, is to look at the February 27th, which we just looked at. Now, compare that to the next expiry. You see here March the 2nd, a few days later, you see that just the huge difference you're paying in terms of the earnings there. Now, in terms of the skew, if we look at the sort of at the money here, you see obviously the put skew is very much well, it's skewed, excuse the pun, towards the put. So much more expensive in terms of implied vol. Basically, as soon as you're looking at the puts, where not so much for the call. So the market does seem to be skewed a little negatively, at least there. And again, you compare that again. This is the February 27th expiry, which is the just the 3-day one or the 2-day one. But again, much higher. You look at the premium you're paying here on the skew compared to the further out, the March and the April expiry. So you're paying a huge amount extra skew there, and you just see how aggressively skewed it is for towards the puts, the more out of the money puts there. Just moving on, interesting here just to see just the dispersion of all the open interest here on the puts and the calls. You can see here that if we look, this is again not only for the February 27th expiry a few days, but also the standard ones in March and April, and you can see where a lot of that stuff is where a lot of this is sort of concentrated. So what I want to look at now is, you see this is a huge one here at around about the 203, but let's just concentrate on the purple, which is actually for the earnings. Okay, so this is the February 27th one, and you can see here that in terms of the calls, you can see here that the two big strikes is 195. And you can also see 200. So massive open interest. A lot of people very interested at the 200. And then if we look on the puts, you can see that really, basically, pretty clearly evenly distributed between 185, 180, 175, all of the even numbers, but 190. So really the three big strikes, you've got 190, 195, and the big one is maybe 200 on the upside. So that's kind of interesting just to keep an eye on that. So that's just a bit of an option sort of overview there for NVIDIA. So let's see how it comes out. And again, I think it's going to be super important, because if NVIDIA gives a strong forward guidance, strong earnings, general positivity, it's all good. No one's overspending on CapEx, but there's huge demand and it's all positive. And we put that in also in conjunction with Anthropic yesterday, giving a slightly different vibe, saying, hey guys, we're not here to disrupt. We're just actually going to be helping people. That could be an interesting counterweight to, as I said, that earlier narrative, which we've been seeing for a week or two of, oh my God, software is going to be destroyed, but chips are going to be good. And, we're coming into a recession. So interesting kind of situation there. Now, let's just quickly look at a couple of other markets. Okay, so we looked at the equities there. Where are we? Let's have a quick look. Okay, so just briefly to touch on a few of the other markets here. As I say, it looks like this morning is like the S&P. As we see, global markets and emerging markets doing very well. But if we just look at, let's say, the ES here, like yesterday, I have nothing much more to add. Yesterday was, a positive day, but essentially we're still sort of grinding in a range between about 68.50, and apparently there's a lot of dealer gamma at 6,800, and that basically means that negative gamma there, though, that if it goes below 6,800, that's when the dealers they'll have to start hedging their positions more aggressively and will actually be selling into weakness below about 6,800. There's a big sort of gamma wall down there. Negative gamma starts to kick in. So we're really trading in this range here between, around about 68.50 up to 69 here, 69.20 or so. And really the key level to watch is going to be that 69.30, which is the fib level, which is also the recent kind of caps on the top. And obviously, if NVIDIA comes in and the positivity continues, for sure, can we reach the new highs or test the recent highs? Why not? And again, if we look at NASDAQ, a bit weaker, similar kind of situation here. It's poking above its 61.8 fib retracement, as you can see. But really the key level there, similar to yesterday, is still about the 25 150 level. And, to be honest, it's probably going to depend on NVIDIA. But this is quite positive price action we're seeing. Also in the Russell, looking pretty good. So US equities are generally having a sort of a relatively sort of happy moment at the moment. If we look across at some other markets, what is interesting is that the bond market starting to sell off a little bit. We had some positivity the other day. If you look a couple of over the last couple of trading sessions, we see the ZT, the front of the curve coming down, ZF coming down, ZN coming down, ZB coming down. But again, notice at the front end of the curve there. So we're really seeing, those yields going up at the front end. So we're getting sort of a flattening kind of situation. And if we just look at what's happening is that the market is pricing out. I talked about the sofas yesterday, but the market is pricing out a little bit the sort of Fed cuts. It's pushing it later and later. And if we actually look, I've got some charts here. What did I want to show you? Yeah, just this is just from the CME. Again, just looking at the SOFA curve, you can see here that you see at the very front of the curve. So let's say March, June of 2026, you see the market is pushing higher here. So this is higher implied yield. So a little more hawkish, but you actually can see that the cuts are pushed lower. So a lower terminal rate and a longer cutting cycle, but more into 2027. So I spoke about that a little bit yesterday. You can see here that the market is almost saying, hey, the economy is kind of not bad for the next few months. So a bit more hawkish in the short term, but hey, we are worried about AI taking jobs maybe in 2027, and maybe the Fed's going to have to come in a little more aggressively. And just if we look at it relatively short term here, you can see here this is for the cut in June. Sorry, for the June FOMC meeting. You can see here that basically over the last sort of week, 10 days, the market had been pricing in, almost like well, I don't want to say a full cut, but let's say about 20 basis points. So negative 20 basis points, 80% of a cut in June. And you can see that gradually, over the last, the last week or so for the June meeting, that's gone down about 7 or 8 basis points. So now we're only pricing in half a cut, so about 12 and a half basis points. So definitely a little bit more hawkish. And we're seeing that, if you look at the like the 2-year having a little bit of negativity over the last couple of days. And that's sort of a risk-on thing. It's like the stock market starting to push higher, maybe less negativity around sort of AI's disruptive potential. So just keep an eye on the bonds there. But again, notice that that's really at the front end. For the crypto, having a slightly better day yesterday, the BTC. But still a weak price action. But hey, at least it was a little bit of a bounce and it didn't make a lower low. So that's a little bit of positivity. The Chinese market are back. So you see here, copper starting to push higher out of the range. As I say, it's held at the 61% fib. It now has a little bit of resistance here, but copper's starting to do pretty well. And we saw that gold and silver continue their rally, quite positive price action. What I was saying yesterday is that we did have a bit of a bump, but as long as on the short term, you see the short term fib here, and I'll put this on a 4-hour chart for gold, just to bring this into a little bit more perspective. You can see that on the shorter term fib, which is what you have to do, is to see if the bulls are in command or the bears. You can see if we just take it from this little impulse here, and basically it's trading very perfectly technically at the moment, gold. So it's quite easy really just to be sort of day trading this. So you see the recent high here, we had some overhead resistance, and then you say, well, okay, are the bulls going to come in? So we just draw a little fib here from this recent sort of uptrend, and you can see that they came in exactly at the 38% fib level here. So this is very positive price action, I would say, for gold. This is trading exactly what you want to see. You see, sort of reaching levels, coming back, consolidating, and then on the fibs being bought by the bulls. So this is quite positive. So if we were to extend this logic, we can do a Fibonacci extension as well, and we can say that in theory, one could sort of hypothesize that gold is going to sort of retest its highs at about 52.70, and then potentially could break out, and the fib extension targets conveniently line up with more or less at the recent highs. So gold starting to look pretty good. Silver also starting to break out aggressively here. So you see that silver probably has a little bit of a test maybe at this recent high at $91.8 here, but silver also breaking out. So the metals, both precious and industrial, looking quite good. So a little bit of risk on there, especially in the silver and sort of copper space, outperforming gold this morning. So that's a bit of risk on. in terms of oil, again, Trump last night said it was a bit wishy-washy on Iran. It's like we want them to not have nuclear, but we want a deal. So I think Trump is a little nervous about just sort of going in willy-nilly with the military option, but who knows? Anything is possible. As you can see here, oil obviously a very clear sort of trading range at this point, about $67 down to 65.30-ish. So that's the trading range right in the middle here. I think, if it gets down here for sure, that looks like an interesting buy around about that level and the 50-day EMA. But at the moment, that's going to probably depend on geopolitics. Just keep in mind, we had API data, the private infantry, and we had a build. I think it was about 12 million last night or yesterday afternoon at 4:30. We did have a build, a very big build. A bit of a draw in gasoline and the distillates, but the build was very substantial and much higher than expected. And that is a negative for oil. So keep in mind, as Trump said last night, drill, baby, drill. There is a lot of oil being produced in the US. And it's only really geopolitical tension, I think, which is keeping oil in this range. I think if the situation in Iran were to resolve itself, we could see oil having a little bit of a puke downwards. Maybe not massively, but maybe, wanting to test below this area. But we'll get an update today. We have the official government, DOE oil numbers. So let's keep an eye on those numbers. And, as always, be comparing that to the expectations which were engendered by the API numbers. Finally, just on the FX, not a huge amount to say. What I will say is that the Aussie, we had higher than expected CPI last night. So the Aussie dollar, put it back on the daily, the Aussie dollar breaking out, or is it out of this sort of channel here? But the problem here is that the US dollar risk on US dollar is doing okay. And the problem is that even though the CPI in Australia last night was a little higher than expected, so that's a bit bearish, a lot of this has been priced in. So we know that there's a bit of inflation there. We know that the RBA is a little hawkish, and we know that the economy is doing quite well. So a lot of this good news, you have to look, let's say back until Christmas, the Australian dollar at this point has gone up against the US dollar in the last couple of months, almost 11%, which is a lot for a major FX pair. So I just wonder whether, a lot of this, like the next hike is priced in for May, is a lot of the good news priced in? Maybe. And also, I was looking at the Commitment of Traders report, and basically, in terms of positioning, the market is very, very, let's call it long on the Australian dollar. So the positioning is quite stretched long. So, maybe there's fewer and fewer marginal buys up at these levels, and we may actually see a bit of a pullback in the Aussie dollar. So that's that. Okay, guys, I've spoken enough. We'll leave it at that. So we know what's going to, well, we don't know. Let's see what happens in NVIDIA. And let's just watch just the sort of the sentiment during the day and these little subsectors of, sort of the software and the chips and whatnot. Just see how all of that is playing out. Okay, have a great trading day, and be back tomorrow with the macro snapshot from the macro shop. Thanks very much. Have a great day.